welcome to Starting Up. This week we come to you from the Marine Plaza Hotel here in South Mumbai. Now, if you thought giving up equity in your enterprise is the only way to scale up your startup, well, think again. We've got a debt special this week on the show. That and a whole lot coming your way. On the show this week, look beyond equity. We bring you the various debt options for your venture. What are you eligible for and what are your options? Jewelry is the latest trend in the e-commerce space. We tell you what's glittering and what isn't on our trend wheel. And finally, it's an exclusive with Mark Kaktikov of Mesa, one of the hottest startup-focused investment banks in the West. What's hot, what's not, and what should one look out for? Now, for the longest time, angel and VC funding has really been seen as the most preferred source of scale-up capital. But guess what? That is slowly changing thanks to all the debt options available there in the market. Vishal Chandravardhan evaluates the market for us and tells us what the options available are for startups.
For any entrepreneur starting up, part of the startup dream always has the alphabet VC somewhere within it. But hey, there could actually be a cheaper option, good old debt. And 50 million SMEs across India are asking that same question. How and where can I get hassle-free debt? One firm which has been helping entrepreneurs with exactly this question is Biz2Credit. Since 2007, the startup has acted as an arbiter between lending houses like banks and startups looking to raise debt.
So what Biz2Credit is doing is that at one end it's helping map out the underwriting and the credit criteria that is being provided by the banks. And then on the other hand, it is helping small businesses prepare themselves to put out a professional case and the best case out to the banks.
Biz2Credit has managed to raise more than $400 million for nearly 1.6 million users in the United States. And now they are looking to finance startups based in India. In association with banks, they offer 4 debt packages for addressing different schemes. And these schemes range from an unsecured debt package to an expansion plan package. The loan tenure varies from a minimum of 1 year to a maximum of 5 years. And the amount itself varies from $500,000 to $400,000. The documents required include copies of an identity proof, tax returns, copies of an educational qualification, and bank statements of the founder for the last 6 months. Beyond all this though, it is the soundness of the business plan that makes the biggest difference. And it is in the fine-tuning of this that Ramit and team play a large role. One entrepreneur who has benefited from this is David Kalsang, founder of Malamal, an import house based out of Delhi. In order to set up his operations in India, he showcased his US credentials, gained credibility, and managed to raise debt through the Biz2Credit platform.
For me, myself, starting back from New York to help me get $400,000 in line of credit, and as of now, for further expansion, they are helping me out with additional $500,000 in line of credit.
The interest rates on debt from Biz2Credit depends upon the bank you approach and varies between 12 to 14%. Another option one can look at is SIDBI. They have set up a separate direct credit scheme which offers loans between 25 crores to 250 crores at a lending rate of 12.75% per annum.
We have set up a 2,000 crores risk capital fund, out of which 100 crore has been carved out for the startups. And we are looking at technology entrepreneurs to support under the scheme. Most of these, if you see, new economy enterprises don't create assets, and they require a different kind of dispensation, which the conventional banking is not able to extend.
SIDBI assesses your business plan before taking a decision, and once it approves the loan, it requires no collateral from the startup whatsoever. Another trend that's emerging in this space is converting some portion of the debt to equity to make a consolidated package. One company that decided to avail of this offer from SIDBI was Umesh Sisodia's Circuit Sutra Technology. Operating in the semiconductor space, Circuit Sutra raised 90 lakhs to upgrade its R&D facilities and to take the business abroad. Yet in his case, SIDBI preferred to combine a package of both debt and equity.
We proposed to them that we can give you a 1% equity in the company at the face value. So it is at the face value, that means you don't have to do the valuation of the company. And it is just a 1%, so we are not much concerned about like giving 1% equity. And so it is giving the benefit of both the birds, like debt and equity.
Another option is to take the debt equity package completely upfront, and that's what Silicon Valley Bank offers. Established as a non-banking finance company, SVB provides debt to companies which have successfully raised their Series A round of funding.
So if you think about it traditionally, companies right from the time that they have started out have had very little alternative access to forms of financing other than equity. And so they've had to kind of sell equity at each stage and then raise more capital to grow. What venture debt is quite simply capital that's available to the company in between rounds of equity financing that can help the company to sustain life and run a lot longer in between those rounds of financing so that they're more valuable when they hit the next round of financing.
The loan amount here varies between $500,000 to $3 million at a fixed rate on a 36-month tenure. The catch here, however, is the collateral. Not only does SVB require you to give them equity warrants, but they also gain the right to be first investors in further capital raising rounds. What comes through across all these fundraising options is the strength of your business plan, and the strength of your execution is the key. So in a lot of ways, it is not too different from the equity fundraising process. It's just that the stakes for the investor are a whole lot lower. The banks will provide you with all the debt you need if looking to set up a new office or buying hard assets is what you have in mind. But if you're looking to be the next tech wonder, funding your new invention, then perhaps equity is a much better route to take. So the question really is, how do you plan to raise the capital that you need? And here at Starting Up, we hope that we've made your decision a lot more simpler.
And if you'd like any more information on any of those fundraising options, well, go ahead, write into us. We'd be happy to help you. Let's take a breather here then on the show, but coming up. Jewelry goes the e-commerce way. We get to that story after the break.